Variable rate mortgage payments have almost doubled, but rents aren't rising nearly fast enough to cover the payments. So what do you do if your tenant gave you their notice to move out and renting it again will put you in a horrible negative cash flow position where you're bleeding money every month? Do you take this opportunity to sell when prices have already declined by 15 to 20% or more in some parts of the Greater Toronto Area? How do we navigate through this? Let's run through some general strategies and hopefully it'll give you some ideas to solve this problem. There's no easy answer to this mess and everyone's individual scenario is different, so this advice may or may not apply to you directly. Remember, you can always click below to schedule an appointment to chat with me and we can talk through your scenario together so we can make the best informed decision. If you can picture yourself in this scenario, you may be wondering, will prices ever come back up or will they continue to fall even more? Is there a possibility to refinance in the future? Or is it worth it to stop bleeding and just sell at a loss now? But before we continue, let me say there's other asset classes other than condos that you can own to mitigate some of this risk and offset some of the effects of vacancy. I'm talking about multifamily real estate investing. The more units you have, the more vacancy risk you can absorb. And for the price of a condo in Toronto, you might be able to get a multifamily property just outside of the GTA or pull some money with some friends to get a larger building in Toronto. The typical home price across the country fell as much as 17% after the Bank of Canada started raising interest rates last year, and some areas have been hit even harder. If you remember, home values started to rebound in February this year after they said they would take a break from hiking rates. That break only lasted 4 months and home prices have started to fall again. The average price of a home in the GTA is just now over $1.125 million as of October, and the price of a home has dropped by $209,000, over 15%, since February's 2022 peak of $1.334 million. The average price of a rental in Toronto is just over $2,900, and to buy the same condo in Toronto is $729,000. With a 30-year amortization at 20% down and 6.39% mortgage rate, that payment will be just over $3,600. And this doesn't even include property taxes and maintenance fees, assuming you add on another $250 for property taxes a month and $450 for maintenance fees. And that brings you a carrying cost of $4,300 per month. And if it rents only for $2,900, that would leave you a cash flow negative gap of over $1,400 per month. And I fear that if interest rates stay higher for longer, things will get worse as investors dump their properties and people can no longer afford to carry their properties as renewals start to happen. As we saw in a recent article by Financial Post, 3.4 million Canadians will have to renew their mortgages by 2025. So will prices continue to fall more? Probably in the short term while interest rates stay high. There's good news for mortgage rates as bond yields start to fall on the news that Bank of Canada is done raising rates hopefully. And that means that fixed rates should come down over the next few weeks. Either way, not only do these interest rate payments are prohibitively high, the added qualification of the stress test due to adding another 2% of the contract rate makes it really hard for anybody trying to qualify for mortgage now. Rates really have to start coming down for buyers to start feeling comfortable taking on more debt to purchase. Despite that, we're at a huge supply shortage with over 1 million people coming to Canada every year and not enough homes to meet this demand. The Canada Housing and Mortgage Corporation says that Canada will still need to build 3.5 million more houses above and beyond what's currently planned in order to restore price affordability. Last week, research firm Urbanation published data saying that only 13,000 condo units were launched in Toronto this year, when the market's been expecting 27,000 units. We're also seeing some smaller and even larger developers running out of money going into receivership. Not to mention, new construction sales have hit the lowest volume in the past decade because buyer sentiment is at an all-time low. So if investors aren't buying and developers aren't creating the housing supply that the market needs, it's a no-brainer that prices won't be coming down anytime soon. It's just a matter of whether or not you can hold up for another cycle. If you have a renewal coming up in the next year or so, and the payments will drastically increase from your 2% rate that you have now to something in the 6 or 7s, maybe it's a huge factor that you have to consider, obviously. Or if you're currently in a high interest rate mortgage, let's explore some of the options that you may have. Maybe there's an option to blend and extend your mortgage where you can increase your existing mortgage and the lender will average out the old rate with the new rate on the new portion of the loan. Just make sure there's no hidden fees and no hidden penalties when discharging your existing mortgage. Because sometimes lenders say there's no penalty, but then they just build it into the blended rate, so just make sure of that. If you have enough equity in your property, you can ask your lender for home equity line of credit to be in second position. The best HELOCs I've seen lately are at prime rate, which at the time of this filming is 7.2%. It'll be difficult to qualify though, and the max loan value you can get is 65% for the combined mortgage and the home equity line. So if you don't qualify, there's always an option of a private loan as the interest-only second mortgage. It won't be cheap. You'll see rates of 12% or more depending on the borrower risk and fees. At least you have the extra capital to carry you through these tough times. It's not a good long-term solution, but it'll be helpful just to get you back on your feet. Plus, the good thing is that the qualification on these loans are less stringent. If you have no choice but to use a non-prime rate HELOC or a private mortgage, have a plan to pay it off or change it to a low-rate bank lender in the next 12 to 24 months, or else you'll end up with a never-ending cycle of high rates for years. If tapping more of your equity seems like you're dancing on the edge of financial ruin, selling the property actually may be a smart move. When managing the payments get too tough, reining in your capital and selling your home or renting it to wipe out the debt and start over with a clean slate might actually be the best solution. If you have an upcoming closing on another property, say you bought another pre-construction condo, or you have a payment coming up for something else in your life, maybe now is the time to take some chips off the table, at least until the dust settles. So in closing, I know it's rough times for everybody right now, but the Bank of Canada is doing this by design, mainly for homeowners, so that we rein in our spending and control inflation, because it's hurting a lot of people. So I know it's tough times, just hang tight if you can, and again, reach out if you have any questions. And before you go, don't forget to click on this video here, and you'll get to see a different glimpse on that multiplex investing like I was talking about. It's called forced appreciation. Look forward to seeing you in the next video.